Hi friends, Simon here from InformedTrades.com. Today is Friday, January 8th, 2016. Time for our weekly chart review. On the screen right now, you're seeing a weekly chart of the S&P 500. Really seeing a lot of weakness to start the new year here. One, we have a pattern of lower highs, and that pattern, you can see that right here. That yellow square, small yellow square marks the absolute high, and we've been trending down. You see this upper dotted blue line, dashed blue line, excuse me. Pattern of lower highs that started on May 18 of 2015. So we've had this pattern in place for a while. It continues. That to me was the real sign, the beginning of a sign, or really we have a confirmation of a pattern of lower highs in July of 2015. So this bear market has been, or this decline has been a long time coming. We still see that holding true today. Now, in terms of, we're below the 50-week moving average, which is another major sign. We broke out of the channel. To me, this move here, when we broke out of the channel in August 2015, that was the clear sign of, all right, it's time to be more cautious, to take some profits or close out some of the riskier positions. We broke out of channel. We have a pattern of lower highs. We're below the 50-week moving average. The next barrier really is 1830. There's major support there, as well as this trend line that goes all the way back to, probably have to look out to the monthly chart. That goes all the way back to the 2009 lows. So we still have this trend line that is intact. And let's see if price, we're getting close though. So let's see if the market supports that. Now, while obviously there's a lot of signs of bearishness now, and I do think it's time for caution. I've sold some positions in August, as I mentioned. I still think that the Treasury bond market is going to be even weaker as rate hikes continue, and I think that could result in equities actually going higher. So I don't think it's completely wrong to have some positions on board. I still think there's a bit of choppiness, and let's see how the market reacts at 1830. But I think the bigger idea, at least for me personally, is to have capital ready. We could see a big fall all the way down to 1550. I think that's within the realm of possibility. So if we see a big decline and then an accumulation pattern where the market's in a range, I think that would be an interesting opportunity to buy, a very good opportunity to buy. So I'm sort of leaving some capital aside for that. Now, in terms of other indices, FTSE, across the pond in Europe and Britain, this index is also at support, or is declining and is now at support. So we may get a brief rally from here. In general, I think all these equity indices are going to be moving together, are going to have equity correlation around the world. So I think there's room for potential decline here, but we are at support, and we have some wicks here, so there is potential that the market will rally, at least momentarily, from here. Same thing we're seeing with the Hang Seng Index, almost at support. You can see at support here, this black line, 20,000 pretty much. That support level was established in June of 2013. When the market fell back to it, the market rallied for all the way up here, basically 2 years. I don't know if we'll have a 2-year rally at this point, but I think it's reasonable to expect some kind of rally when the market runs the support here. I think we'd have a lot of profit taking, and that could, from shorts covering, and that could cause a brief rally, perhaps all the way back up to 23,129. But maybe even, a little bit less than that as well, maybe 22, 21.8, something like that. Of course, like I mentioned, I do think Hang Seng Index is also going to be correlated with S&P, and if we have a big move down in the S&P 500, we're going to see a big move down in all the global equity indices. FXCM dollar index is now at resistance, right? So it's retesting the levels it was at in November 2 months ago. So let's see how this works. If we clear this level, if we clear this red line, that could pave the way for the next leg up. And, we also have, fundamentally, we also have the Fed basically saying they're going to continue rate hikes incrementally this year, and that could also be a catalyst for dollar strength. Futures dollar index, a similar story in that we have not, or still have to clear the resistance level going back to November 30 of last year. Now, if we look at this chart, it's clear that that resistance level actually was established in March of 2015. So really clearing 115, big psychological barrier there as well. Futures dollar index, that could pave the way for the next leg up. However, until that happens, you still have a case for a dollar sell-off. So the way I'd be looking at this is if we clear 115, that's the cue for a sell stop and sort of a move to, or excuse me, a buy stop and a move for, the expectation of following the momentum and that we've now cleared the way for a move higher. Dollar yen, I have a position on dollar yen. It's basically at break even now. We're back at the support level that we've been at for quite some time. We spent most of 2015 hanging out, or at least the first half of 2015. Well, actually, and then we came back and tested. So truly, most of 2015, right around 118, and we're now at this level. One key difference this time is, well, we're below the 50-week moving average. That's not that unique, but we are below this trend line that goes back to 2012, and that is when the dollar yen rally truly began. So this is the first time that we are really below this trend line. To me, that's a big deal. I'm still bullish on dollar yen for fundamental reasons, but one could argue, especially that with the dollar index, we are seeing, we haven't cleared that resistance level yet, and we're seeing dollar yen below its trend line here. So one could argue that maybe the dollar is in for some weakness and that we're going to head down further. Maybe there's room for a big decline. To me, I just think the yen is so fundamentally weak that it's not a huge... I'm comfortable being long dollar yen for quite some time because I think the yen's problems are ultimately going to catch up to it. So to me, this is potentially an interesting buying opportunity, and if we can get a pattern where we hang out at this level for a few more weeks like we did in earlier and for much of 2015, then I'll probably be adding to my position. But let's see how price fares out over the next couple weeks. Dollar yuan. Now, actually, dollar, in order to get a proper price perspective, we have to look at dollar yuan offshore. Now, there's the offshore exchange rate for dollar yuan, the onshore exchange rate. There's a little bit of a difference there. China has loosened its peg and devalued the yuan. That has sent the dollar yuan exchange rate soaring. We talked a little bit about this last week, or in our year-end video for last year, about how the pair was at resistance and there wasn't much of a barrier to the next resistance level. That story is still true, but now we have to look at the offshore chart to really see it. There's still room for a 3% move before we even run into resistance that goes back to August of 2010. So dollar offshore yuan still could be a lot of room there. However, personally, well, if you're going to play the dollar, I think dollar yuan is an interesting idea, just because even though it's rallied a lot, there's just no resistance up here. But really, in terms of long dollar trades, I think it would be, I'd really like to see it clear this resistance level that we're seeing on the dollar. Now we're looking at the monthly chart. Let's go back to the weekly chart. There we go. Clearing this level, I think that will pave the way. And just to get an idea, if we do look at the monthly chart, if we can clear 100 on dollar futures index, then we don't have resistance to 108. So it could be a pretty sustained move through the year, and 120 beyond that. So let's see if we can get past 115. Could be some opportunities in going long dollar if that occurs, if we can clear that level. Okay, gold. Good week for gold. Interesting technically, we did hit the bottom of this price channel. It's better to see it on a weekly chart. And we did rally right after we hit the bottom of this price channel. So I've been accumulating steadily. I still think it's good to accumulate steadily. From a trader's perspective, though, we are definitely still in a downtrend. We need to clear at least a 50-sim moving average, preferably 200, 1200. Preferably, if we break out of this downward channel, then it's like, all right, we have some legs beneath us. Now, I do think that we're ultimately going to go past the 2011 highs, but that obviously requires some patience. It's probably unlikely that it will happen overnight. So I think this is a great opportunity to accumulate if you have a long-term perspective. For a trader's perspective, personally, I still want to see additional momentum build before thinking that this is going to go higher. And if we do reach the channel here at 1200, I think that's, from a trader's perspective, we're going to be at the top of a channel. That's a good indication or a good time to sell or take some profit or be cautious if you're looking at it from a shorter term perspective. Last but not least, crude oil. I did put on an order earlier this week, first order of the year. to go long crude oil. Right around here, this green range, I've been waiting for price to fall into this green range. If we zoom out to the monthly chart, and you'll see why. It's because this is a range that was the bottom in 2009. I think it's going to be a major support level. So I think it's worth putting on a big position here, or a larger position here. You know, I did get in at 44. I left capital in case we fell down here. Now, next support is 26. Let's see if we get to that level. I think there's a reasonable chance that the market could sort of hang out around here for a while. I'm not sure if we're really going to fall into the mid-20s. Now, oil fundamentally still costs about, you know, even conventional methods, $70 to get out of, $7 a barrel. And if you're looking at the unconventional methods, the tar sands, it's closer to $90 a barrel. So I think ultimately the world still needs oil, and we're still going to need a higher price to continue drilling. So I think fundamentally this is also a great time to buy if you have a longer term perspective. From a trader's perspective, let's see, you know, technically, you know, we are in the range here. We do have a long wick candle, so that's a bit nice. There could be an opportunity to buy here and sell at 37.70. I think that's a clear 37.70 is a clear resistance level. Buying around 33.50, and if this level is cleared, then as we noted, there is support at 26.50 or so. We can see it on the monthly chart. Yeah, 26.12. So that could also be an interesting level to buy at if you want to keep some capital ready for that. That's about it. Any questions you have, anything you want to add, join us at informedtrades.com. If you like this video, if you help us learn, help us out. Like this video on YouTube, share it on Facebook, Google+. That helps us grow, helps us make more videos. Best of luck in your trading and investing. We'll see you next time. Take care.